Okay, see, first of all, equities. Okay, now when so let me begin from the basics. Okay, say for example, let's say you have, you are starting, you are planning to start one business, one coffee shop business with, let's say, 1 lakh rupees. So this 1 lakh is called as what? Capital. What do you mean by capital? Capital means money required to start your business or to expand your business. Now this type of business is called as what? Sole proprietorship business. Now in a sole proprietorship business, only one person is starting a business. He is single-handedly responsible for his business. Okay, this is case one where he has alone contributed capital. So we are focusing on capital, like in different business, who is contributing capital. So in your sole proprietorship, the owner, whatever savings he has contributed, and then he started his coffee shop. Now case two, imagine, he is Mr. X. Mr. X gets in touch with Mr. Y, and they both are together starting the business. When they both are together starting the business, let's say Mr. X brought in 5 lakhs and Mr. Y brought in 5 lakhs. So together 10 lakhs required. So Mr. X approached Mr. Y, and they both are equally contributing and starting this business. Okay. So in this case, now imagine tomorrow if this company is making 100 rupees profit, 50 rupees will be taken by X and 50 rupees will be taken by Y. Okay, now what type of business is this? This is partnership firm, correct? And this is partnership firm, partners. Okay, partners are coming and they are starting a business. Now partnership, you can break down this word as part ownership. Now what do you mean by part ownership over here? They are partly owning this business. When I say partly owning this business, they are partly owning the shares of this business. So what do you mean by shares? Shares means what? Shares represents part ownership. Share represents part ownership. Now what do you mean by part ownership? You can connect this word shares even in the non-financial world also. In the non-financial world, how will you connect? Say for example, when you say I'm sharing food with my friend. So what does that mean? Sharing means you are giving part ownership. Okay, when you say I'm sharing food with my friend, I'm sharing food with my friend, that means you are giving part ownership of food to your friend. Or imagine, in my birthday celebration, I'm giving a piece of cake to my friend and I'm saying like this is your share and you have to finish it up. Or during pizza party, we give you a part of, we part shares, we give it to our friend and say like, you own this is yours, you are supposed to finish up this part. That means shares is something, this word we are using in the non-financial world also. So what does this represent? This represents part ownership. Part ownership. Part ownership. So over here, part ownership in the capital. In the capital. Part ownership in the capital. Okay. So shares represents part ownership in the capital. Is this fine? Have you understood this one?
Yes, sir.
Yeah. Okay. Then imagine case three. Now this person, maybe he requires 50 lakhs, so he gets in touch with his friends as well as with his relatives. Now each person assume contributing 10 lakhs. Okay, if each person is contributing 10 lakhs, five people are there, so what percentage will each person own? Each person will own, imagine,
20%.
20
20%.
percentage. Yeah, so each person will own 20. So if this company is making 100 rupees profit, then 20, 20, 20, 20, and 20. Okay, like this they are going to share. Now this is a private limited company. Okay, let's say this is structured as a private limited company. So now, see, it looks very theoretical to say that all are contributing equal amount. Practically, it may not be the case. So practically, what will happen? Some will contribute like 15 lakhs, some will contribute 3 lakhs, some will contribute 5 lakhs, some will contribute 12 lakhs, like this. And so the proportion also will change. He might be owning 30, he might be owning 15, he might be owning 22, he might be owning 18. Like this, it can change. Okay. So yeah, this is when you are raising capital from your friends and relatives as well. Okay, private limited company. Then let's say further, next case, imagine the business is further growing. Now you require maybe like something like 100 crores. Now quite possible that you uh, you are approaching a private equity firm. Now privately you are selling, but to some unknown person, unknown company, in fact, unknown person, or some other other professionals, rather professionals. Privately you are selling your shares. Then it becomes what? Then it becomes private equity investments. So private equity means what? Some other companies are privately buying the shares of your company. Like even here you are selling the shares. First you sold the shares to your friend, then you sold the shares to your relatives. Now you are selling shares uh, to a professional company. Okay, private equity investors. So privately you are selling and privately they are buying it. Okay, so this is private equity investors. Then next case is, imagine next case is imagine now you are a big brand. Now this has become cafe coffee day or Starbucks or something like that. So now you require probably 1,000 crore. Now when you require 1,000 crore, because you want to set up branches across the country. Now when you want to set up branches across the country and you require 1,000 crore, now this is what? This is cafe coffee day. Now you are going to the common public. Now you are raising capital from the common public. Now when you raise capital from the common public, this is called as what? IPO, initial public offering. Now, what do you mean by initial public offering? Initial public offering, initial refers to first time shares are being offered to the common public and you are raising capital from them. That is called IPO. Okay. So here, so these are all different ways for one to raise capital. First one, all own capital. Second, with your friend. Then friends and relatives. Then another professionals, but privately. Here, going to the common public and raising capital. Okay, this is IPO. Now when you are raising capital, how are you raising capital? By selling shares. So when you sell shares, okay, so I'll write this here. This is CCD. Okay, now this is CCD. You are selling shares. This is IPO. Now this part, okay, now see, now this becomes market. Why it becomes a market? Market means what? Market means where buy and sell activities happens, right? That is called market. So uh, here cafe coffee day is selling shares. They are the seller, and these investors are the buyer. So selling and buying, and so this becomes a market. Now we have to do a naming ceremony for this market. So the naming ceremony for this market. So what is the naming ceremony? What name would you like to give to this market? Any guesses?
Primary market.
Yeah. Okay, it is called as primary market. Now, why it is called as primary market? Primary refers to new. Primary refers to new securities. Okay, new securities being offered. Security is a general term, okay, for any financial instrument. Security is a general term for any financial instrument. Over here, we are speaking about equities. Okay, it can be for bond also. Same steps for bond as well, but Let's stick to equities now here. Security, we are referring to equities. Okay. So this is primary market. So what do you mean by primary market? Primary market, if you don't know, you note it down. Okay. Primary market is a market where new securities are issued. Primary market is a market where new securities are issued. Okay. Then what will happen? So this also you can compare it with with your non-finance life as well. So imagine you are going to your dealer shop and you are buying iPhone. Now what kind of market is this? Some you are buying and the dealers are selling. So it is a primary market. New iPhone you are buying, brand new iPhone you are buying. Now, so this is a primary market. But then after few weeks, months, years down the line, you might not like that iPhone anymore. So now you cannot go back to the same. You cannot go back to the same. Uh, the same dealer shop and say, I don't like this phone anymore. Take it and give back my money. They are not going to give it to you. So what will you do to sell that iPhone? What platform will you use? Where will you go to sell? Any thoughts? Normal behavior. You think like you have your phone. You bought it a year back. Now you don't like it.
Selling it online.
Online you will sell it. Okay, right. Okay, so you will sell it online as in what? So when I say you will sell it online, you will, let's say example OLX. Okay, so you will take OLX's help and you will sell it online. Correct? Okay, you will sell it online. Similarly, that OLX's role is played by stock exchange over here. This is that OLX or stock exchange. Okay, now you will go to, so this buyer who wants to sell now, he turns out to be a seller. He goes to the stock exchange platform and another person will buy it. Another person will buy it. So now this is also a market now. This is also a market. Now we have to name this market. So what name would we give to this market? Any guesses? No?
Secondary.
Yeah, this is called secondary market. Okay. Secondary market. So secondary means what? Secondary means already existing company shares being bought and sold. Already existing companies shares. Okay, already existing company shares being bought and sold. That is secondary market. Primary means what? New securities are being issued. Secondary market, already existing company shares are being bought and sold. And together this primary and secondary market is called as capital market. Capital market. Okay. Capital market. So capital market means what now? Capital market comprises of both primary and secondary market, and capital market is a market where long-term securities are traded. Long-term securities. Okay, long-term securities are traded. Now, why do we say securities? Because it is referring to equity plus bonds as well. About bonds, we will talk some other time. Okay, right now let's stick to equities only. So long-term securities are traded, which is what? Equity. So capital market is a market where long-term securities are traded and it comprises of primary and secondary market. And this is how money is moving from one end to another end because of all these systems. Because of all these systems, money is moving from one end to another end. Okay. So like for example, initially these are all the savers who are giving money to this needy. This is the needy company. And the stock exchange is the support system so that it acts as the exit platform. So that whenever they want, they can exit, they can sell their securities and then they can exit from this. So this is how money is moving from one end to another end. Now you take a minute, go through this. and tell me any doubts, questions you have. Any questions, doubts? Shravani?
Understood, sir.
Understood? Okay, fine.
Yes.
Okay. So, see, this is what I was explaining. Three functions of financial system. See, together, all this network is called as financial system. Okay. So now you should be able to understand all this. Okay. Allow entities to save and borrow money, determine the return. Now, this entire system, based on this system, the system will help to decide at what rate uh, interests, you know, what should be the interest rates, depending upon how much money, how much, depending upon all this demand and supply of all this uh, okay, savings. Okay, then allocate capital to its most efficient uses. So you have various options in which security you are supposed to allocate the capital, and accordingly you can allocate it. Okay, so this is all the basic stuff I was covering. Then here, uh, see this one now. LOS 39. LOS is in lesson of study. Okay, lesson of study 39 point B. So here, financial assets. Financial assets, as I said, stocks, bonds. These are all financial assets. Okay. Real estate, I believe you know this. Debt securities, equity securities. Debt securities we can focus when we do fixed income. Okay. Then publicly traded securities, private securities. So private securities means privately issued. Okay, like this part, that private equity investors I said, right? That is private securities. Okay, that private equity thing. Okay. Then derivatives you ignore. Okay, this is derivatives. We have a separate subject, derivatives. That time we will be focusing on derivatives. And then spot market means cash market. Okay, spot market as in cash market. That means immediately based on whatever be the price, on that basis you are buying and selling. That is spot market, also called cash market. Primary market, secondary market we have discussed. Money market. uh, Money market means what now? Capital market, money market. Money market also will be covered in fixed income only, but just I'll give you rough idea. Basically, when we say money market, see, capital market covers long term securities, and money market were short term securities. This is for short term securities. What is this short term securities? All those things that we will see when we come to money market. Okay, now let's stick to equities only. Traditional investments and alternative investments, even this is also a part of uh, alternative investment subject. Okay, but still, alternative, still just rough idea I'm giving you. Alternative, traditional traditional assets or traditional investments and alternative investments. Traditional investment means uh, equities, bonds plus cash. These are considered as traditional investments. Rest everything is alternative. What do you mean by rest everything? Rest everything means real estate is alternative investments. Then real estate is alternative investments, mutual fund is alternative investments, hedge fund is alternative investments, derivative is alternative investments, Bitcoin investing, Bitcoin currencies, that Bitcoin is alternative investments. So rest everything, all these are alternative investments. Okay, all these are alternative investments. Fine. Now don't think that, okay, how come real estate is not a traditional one? Real estate, this is real estate investments. Okay, real estate, uh, over their international definition perspective, equities, bonds, and cash only. Only these comes under traditional. Rest all are alternative investments. Okay. Then securities. So securities, I told it's a general term. Okay, so this can be used for equities. This can be used for bonds as well. Okay. Fixed income, again, let's just ignore all these terms which are not related to actually equities. Okay. Yeah. Now equity, under that common stock, preferred stock. So what are the characteristics of common stock? What are the characteristics of preferred stock? And then we will see warrant. So what are the characteristics? Characteristics of common stock. Characteristics of common stock. Characteristics of common stock is, so whatever you can think about, can you tell me what are the characteristics?
No fixed returns.
No fixed returns. Yeah, correct. No fixed returns. Okay. No fixed returns. Then anything else?
Like they are paid after preferred shareholders are paid.
Yeah. So they are okay. So during liquidation of the company, common shareholders are paid last. Common shareholders are paid last. Then volatility, risk. Correct. You are taking risk. You are getting exposure to volatility when you are buying common stock. Okay. Then you get voting rights. Okay. You get voting rights. Dividend is not fixed. You may get dividend, you may not get dividend. Okay. Then, but capital gains, or capital loss is also possible. But basically, you are entering for capital gains and dividend. These are your objectives. Okay. Yeah. Then, so these are some of the characteristics of equities. Right. Then preferred stock. So what is preferred stock? And what are the types of preferred stock? See, preferred stock means what? Here, now in equity, there is no fixed dividend. Okay, dividend is not fixed. Okay. Just one minute, hold on. Yeah. So preferred stock. So preferred stock means what? In preferred stock, this is another type of stock wherein the characteristics are changing. So here, uh, dividend is not dividend rate dividend is not fixed. Okay, dividend is not fixed. Okay. No, sorry, it's rather dividend rate is fixed. Dividend rate is fixed. Okay, so here dividend is not fixed, right? So in preference shares, dividend rate is fixed. Then no voting rights. Is it making sense? If you are the preference shareholders, would you like this feature, no voting rights? Yeah, no voting rights. Imagine you are the preferred shareholder. Would you be okay with this kind of characteristics, no voting rights?
No.
Okay. Now, then why are they accepting? Okay, so let's say you are your preferred shareholder and you have been given voting rights also. Assume for a minute. Now imagine an auditor is being appointed and they are asking you to come and cast your vote. Now you are, as a good uh, preference shareholders, you are doing a lot of research and you are casting your vote for the auditor. Now there is another person, another preferred shareholder who didn't bother to even cast his vote. That person did not bother only. So at the end, will there be any difference in the dividend payment to both of you?
No.
No. So will it encourage you to do the same research next time?
No, it won't.
So you understood now why voting rights are not given?
Yes.
Because when you get something very fixed, okay, dividend rate is fixed, you don't care about the management, right? Who cares? Even if the company makes extremely good profits because of your decision, you are not going to get anything extra. So that's why you are not being a part of the management. Fine, no voting rights. Then uh, during liquidation, preference shareholders are paid. Preference shareholders are paid before equity holders. Equity holders. Equity means common stockholders. Okay, so they get preference during liquidation. They are getting preference, and also they are getting fixed dividend rates. Okay, these are the characteristics of preferred stock. Okay, then types of preferred stock. Types of preferred stock. So what are the types? Number one, convertible and non-convertible preferred stock. Okay, convertible preferred stock. You can call number two also non-convertible. Non-convertible. Non-convertible preferred stock. What does this mean now? Convertible and non-convertible preferred stock. Convertible means, it can be converted into equities. Convertible means what? It can be converted into equities after a certain period of time as per the ratio specified by the company. Okay, after a certain period of time as per the ratio specified by the company, it can be converted. Say for example, one preferred stock can be converted into one equity. So accordingly it will, after let's say 5 years, then at that time it will be converted. Non-convertible means you cannot convert it. Okay, that is non-convertible preferred stock. Then um, then next one is cumulative and non-cumulative. Cumulative preferred stock and non-cumulative preferred stock. So cumulative and non-cumulative. Cumulative preferred stock is cumulative is uh, say for example, company for some reason could not pay dividend, this year. So next year it will be accumulated and further it will be paid to you. That means you are not going to miss out. Okay, so this year you are not getting, but next year you will get it. That is called cumulative preference shares. Okay. Non-cumulative preference shares means if they are not paying you this year, then you have to forget it only. Okay, you have to forget it, and then you will get next year's dividend. So the dividend is not getting accumulated over here. That is called non-cumulative preferred stock. Okay, non-cumulative preferred stock. So that means dividend will not be accumulated. Then next one is, these are just some types: redeemable and irredeemable. Redeemable preference shares. Redeemable preference shares means what? Redeemable means after certain number of years it will be called back. That means they will take back the money, and then they will take back the shares and they will give back the money, and that's it. The relationship is over. They don't have to pay dividends after that. That is redeemable preferred stock. Then irredeemable. Irredeemable preferred stock is, okay, irredeemable means it will not be redeemed, it will not be called back, and forever they will keep paying dividend for this one. So that is irredeemable. Okay. Then participating preferred stock. Participating preferred stock. Participating means uh, just participating and non-participating. Participating and non-participating. Participating means they are going to pay you, let's say, 10% dividend, plus they will also pay you 1% more if the company exceeds so and so profits. It's like your salesman is being told that you will get this much of salary, but in case if you cross this much of sales, you will get some extra bonus also, that kind. So that salesman is made to believe that he is also a part of the entire progress that the company will see. So here also participating preference shares means whatever progress that will happen, or if a company is making exceedingly high profits, that time if a company is making exceedingly high profits, that time uh, even preference shareholders will get some share out of that. Okay, that is called participating. Non-participating means 10% has been promised to you, take only 10%. No matter how much more profit the company makes, you will not be a part of the game, you will get only 10%. Okay, so that is called non-participating preference shares. So these are all various types of preference shares. Any questions, doubts on all these things?
So could you please explain redeemable preference share again?
Yeah, redeem means, let's say for example, company says that after 5 years we can redeem. Today we are raising capital by issuing preference shares. After 5 years we want to give back that money and finish it off, so that we don't keep paying uh, dividends forever. So they are paying dividends every year, correct? Imagine they have taken 100 rupees. Now if they have taken 100 rupees and they are paying 10% interest, that comes to 10. So every year they have to pay 10, 10, 10, 10. Now the company says, look, after 5 years, I will redeem it. That means I will give you your 100. That's it. When I will give you your 100, then after that I don't have any liability, right? I don't have to pay you 10, 10 rupees. So this is redeemable preference shares.
Okay.
Okay. Yeah. Yeah. Then next one is warrant. Now what is warrant now? Okay. So what do you mean by warrant? See, first of all, what are the different ways for a company to raise capital? One is, through equity, we have seen equities. Then another one is debt. Debt. Okay, so imagine a company is raising capital through debt. Okay, so if in debt, imagine 8% is the interest that the company is agreeing to pay. 8%. Then why preference shares came into existence? Why preference shares came into existence then? These two ways are there, right? This is what this is giving ownership. Equity is giving ownership. Okay, and this is debt. Why preference shares are coming first? Why preference shares are coming? Reason being, see, uh, when you raise capital through debt, what happens is the look of the balance sheet gets deteriorated. How it gets deteriorated? Uh, more and more debt to equity ratio will go up. When debt to equity ratio will go up, debt to equity ratio. If debt to equity ratio is going up, it is not good for the company, right? So when it is not good for the company, then investors will not like it. Investors would not like to invest in such kind of companies where uh, where the debt to equity ratio is high. So the look of the balance sheet is going down here. So now the company is thinking like, what do I do now? Okay, I want to make sure that my company's look is good. Then only investors would like to invest. So they are saying, I would now go for preference shares. In preference shares, what happens? This is structured as shares, not debt. If it is structured as shares, then it is not impacting the debt to equity ratios, right? Okay, so in these conditions, they would prefer what? Preference shares. But mind you, then in that case, everybody will go for preference shares only. There should not be any debt then? No. Here the catch is preference shares are more expensive than debt. So if it is debt is 8%, preference shares will be 10%. Okay, so the company is taking the risk of 2% more to make sure that this looks better. That's why preference shares. Then, okay, fine, this is also there. Then why warrant? Now, what is warrant? Warrant means what now? Okay, so warrant means, now imagine company is in such a situation where it's now imagine company has come just out of some scam or negative news, all such things. So now it cannot raise capital from the public because people are not going to trust this company. So equity is not going to work. Then next, what to do? Then they are thinking, okay, fine, then let's go for debt. But the company is in big problem already. It cannot afford to pay 8% debt, or even if it raises capital also through debt, debt to equity ratio will go up. Further, it will deteriorate the shape of the company's balance sheet. Okay, then what to do? Then they are thinking about preference shares. Now, if they're thinking about preference shares, when they are going for preference shares, now here also they cannot afford to pay 10%. So that is also not possible. Then what to do now? So they are thinking what to do. Now you see here, this company internally, the management feels very strong about this company, that this company is a good company. Okay, it just needs another chance, it will do very well. But outsiders are not going to trust this company now. It is already out of some scam and all that thing, or some negative news has happened. So now who will come to rescue this company? Its own management, founders and management, directors, founders, directors, okay, top management people. Now they will come and then they will say, look, I will invest into this one. In return, they will not take anything also. So warrant is not going to pay any interest as such. So nothing here, nothing here. This is 0, 1, 2, 3. Imagine it's a 3-year warrant. Generally, warrant will be for 3 to 5 years. Okay. It is also called as long dated options. Long dated options. Options again you will learn in derivatives. Options you will learn in derivatives. Okay. Yeah. But then shortly, if I say it is giving you the right to buy, right to buy. So here, okay, right to buy. So here, these investors or these founders, directors, top management, they will invest money into the company. In return, company is not going to give him any interest. Company is going to give them warrant, and warrant does not pay any interest. Then why are these directors and founders doing all these things? Why they are doing all these things? Reason being, um, this warrant, even though is not giving them interest, but it is giving them the right to buy shares at the time of, let's say, at the time of maturity. So when it is giving them the right to buy shares at the time of maturity, so here the hope is, today, imagine the share price in the market is 15 rupees, and these people are buying warrant for 10 rupees. Warrant is 10. Now the hope is what, that they will do a turnaround in the company, and in this 3 years the company's share price will reach to probably something like 50. So when it is reaching to 50, okay, 50, 70, let's say it is going to 70, that time after 3 years, this warrant will be converted into shares, because this is giving you the right to buy. It is like, imagine yourself going to some mall and you are getting the voucher. Okay, that voucher is giving you the right for some discount, or right to get one free and all that thing. Similarly here, this warrant is giving them the right to buy shares. Okay, so that time they will convert, and then when they convert, they are getting shares worth what, 70 rupees. So that is the benefit for them, warrant. Okay, so warrant, so this is how warrant works. Okay, so this is another instrument through which a company can raise capital by issuing this security to the founders and directors and the insiders. Okay, and it doesn't uh, pay interest as such. However, it gives the right to the holders of the warrant to convert this warrant into equity shares at the time of maturity. Okay, is this clear? Warrant.
Yes, sir.
Okay. Now, sometimes even they can give warrant as a sweetener also, along with other instruments. Sweetener means freely given, so that say for example, imagine they are issuing bond. Assume now they know that people will not show interest. Okay. Now people will not show interest in their bond. They are not paying much interest, so people will not show interest in their bond. Then how to attract the investors? It is just like you are going to a mall. Company cannot give you much discount. You like discount, but company cannot give you discount much. So what to do? Give other schemes like one for one free. Correct? You must have seen this kind of tricks that shop owners will use, right? One for one free. So investors will like that also. No? Similarly here also, along with bond, I'm giving warrant free. Now that warrant will give you the right to buy shares after 3 years. This way also it can be used. Okay, so basically all you have to understand is, warrant does not pay any interest, It is also called as long dated options, and it is giving you the right to buy or right to convert your warrant into equity at the time of maturity. Generally, it is valid for 3 to 5 years. Okay, this is warrant. Then mutual funds. See, let's not focus on this one, okay? Because all these are part of other subjects. All these are part of alternative investments. Then currency also uh, not required here. Currency, we will do that anyways in other subjects like economics. We will be doing contracts. All these are derivative subjects, not needed. Options, all these we will be doing in derivatives. Credit default swaps, all derivatives. Commodities, all this you can ignore. Even you don't have to read, okay, all these things whatever I am speaking now. I mean, if you read, it is good only, but right now it is not required. All these will be repeated in their respective subjects like alternative investments and derivatives. That time you will have to read, but if you get more time, you can read now and keep it. Okay, now describe types of financial intermediaries and services that they provide. Financial intermediaries. So intermediaries, uh, they stand between buyers and sellers, facilitating the exchange of assets capital. Okay, now who are these intermediaries? Brokers. Okay, brokers. The brokers, I believe you know, right? Brokers, as in they help clients buy and sell securities by finding counterparties to trade in a cost efficient manner. Normally brokers. Okay, block brokers. Let me speak about block brokers now. Block brokers means what do you mean by block trade? First of all, block trade. Okay, block trade and bulk uh, bulk deal. Okay, block deal, bulk deal. Okay, so what is block deal, what is bulk deal? See here, this is nseindia.com. Okay, now you see, can you see here, suddenly somebody sold highly here? Can you see, suddenly it is like forming a line, you know see, can you see here, this part, highly somebody has sold. Okay, this is what, this is bulk deal. This is bulk deal. Bulk somebody over the stock exchange, they have done the deal, they have sold highly. Okay, you understood what I said? It is like this, it is stock price is going up and suddenly it is falling down. So this is bulk deal. Okay, bulk deal. Now what is block deal? Block deal means, now this is happening, bulk deal is happening during or this is through the stock exchange. Deal is happening through the stock exchange. Deal is happening through the stock exchange. Deal is happening through the stock exchange. Okay. Now what is block deal? Block deal means what? Block deal means, uh, so here bulk deal means one big investor is selling and many other person would have bought it, okay, through the stock exchange. Block deal means one big investor is selling to another big investor, or one big investor is buying from another big investor. Okay, so they privately, they will negotiate the deal. Okay, when they privately they will negotiate the deal. Suppose in the market its price is 100, they might have negotiated for 80 or 90. They will negotiate, and then they will go to the National Stock Exchange platform, and there, there are separate windows for block deal. So using those windows, they both will place the deal. Okay, and then it will come out as a news that block deal happened between so and so, so and so, investor. I'll just show some news also. Wait, like during when Adani Hindenburg report was going on that time, uh, GQG, that is on uh, company, GQG Partners. Uh, okay, they bought it from Adani. Uh, See now here you can see GQG Partners. What are they doing? They are doing some block deals. That means privately they will negotiate with the investor and they are buying. This is block deal. So this is the negotiation between whom? Between Ambuja Cement and GQG. Okay. See this. Bought 17.1 million shares of Ambuja Cement via a block deal on Friday. Okay. Other buyers. Okay. Then some other buyers also. Okay. Ambuja Cement block deal GQG. Like this, you will get plenty of examples that privately. So this is happening privately from one big investor to another investor, or from the founder to other private equity investors. Okay, this is called block deal. Now the brokers who are involved, now how will they know? First of all, so obviously there are brokers involved between them. That broker is called as block brokers. See this placement of large trades. Is it okay? Understood? Block brokers.
Yes, sir.
Yeah. Okay. Then investment banks. Okay, investment banks. So what is investment bank then? Investment bank means what? See, basically investment banks is a financial entity that is helping a company to raise capital. That is their core business. Like initially I said that Cafe Coffee Day is going to the market and they are issuing IPO. Now, when they issue IPO, uh, they don't know how to raise capital. First of all, they know only to make coffee, right? They are not an expert to raise capital. Then who is the expert? That expert is investment bank. They will go to the investment bank, and that investment bank will help them to raise capital, from the market. Okay, so that's what investment bank comes into play. That time they are called as underwriter. When they do this work, they are called as underwriter. So what are the functions of investment bank? Investment bank does many functions. One of the core function, which is their bread and butter, is underwriting. So they act as the underwriter. What do you mean by underwriter? Underwriter is in helping a company to raise capital from the market. Okay, helping a company to raise capital from the market. Okay, then what are the other work that they do? They act as a broker also. Like this kind of work also they will do, like block brokers or brokers. So they act as the broker. Then they act as the dealer as well. Dealer means what? They are placing trade for their own firm, because here they are helping others, correct? Broker, here they are executing instructions given by the investor. Broker means what? Like real estate broker, what do they do? If you tell your real estate broker that you want 1 BHK, he will look for 1 BHK and give it to you. That is his job. Execute what you have told. So broker means executing the instructions given by the executing the instructions given by the given by the investor. Okay, execute. Underwriting means helping companies to raise capital. And dealer is placing trade for their own firm. Now they are thinking, even they have capital, why can't they uh, buy and sell securities? So this is placing trade for their own firm. For their own firm. Okay. Then what else do they do? So this is all functions. Functions of investment bank. So what else do they do? They act as the custodian. What do you mean by custodian now? Custodian, as in, you know, investors are buying and selling shares, right? Now, when they are buying and selling shares, some back end work has to be done to debit and credit all those things. Some operational work of settlements. Operational work of settlements. Settling the buy and sell transactions, or operational work of trade settlements, that is done by the custodian. Okay, that is also investment bank's role, only one of the role. Then they, like this, there are many. They act as the um okay, anything else? Depository bank. We will be seeing this depository bank, in this subject itself. At the later stage, we will be seeing they act as the depository bank. Like this, many functions are there. Okay, they are into asset management. Big one, asset management. Now, asset management means what? Asset management, as in, this is, like, mutual funds, hedge funds, pension funds. Okay, so they manage all these assets. Asset management. Then wealth management. Okay, wealth management is for individuals, HNIs. Okay, so all these are some of the functions of an investment bank. Okay, then exchanges means stock exchanges. Then alternative trading systems, which serves the same trading functions as exchanges, but they do not have any regulatory function. No regulatory function. Okay, also known as electronic communication network. So this is basically for those companies, which are not fitting into the norm of getting listed. Okay, so quite possible that they get traded over here. So this works through some network, electronic communication network, or multilateral trading facilities. So apart from the normal stock exchanges, there is another network also, uh, uh, wherein people can buy and sell. It happens through brokers network. So brokers have formed all this network, and their trading can take place. Okay, so this alternative trading system do not reveal current client orders, are known as dark pools. And so this is another network altogether. Then dealers, so these are not regulated. Okay, ATS is not regulated, remember that one. Then dealer, I told you that they are placing trade for their own firm. So broker dealer, also dealer only. Then primary dealer. Primary dealer means primary dealer. Uh, so primary dealer means basically they will, primary dealer means these investment banks will buy government bond. Okay, it's a wholesale business, you can think like that. They will buy government bond in bulk, that means wholesale, and resell it back to the investors. And resell it back to the investors. okay, and resell it back to the investors. That is primary dealer. So when government, that means, see, when government wants to raise capital, what government will do is they will raise capital from the investment bank directly. That is primary dealer. And then they will further, these investment banks will market, and then they will take to the other investors. Okay, that time they are called as primary dealer. Okay. Securitizers we will see in income statement anyway, not income, we will see in fixed income anyways. Okay, so you can skip this part also, securitizers. Then uh, you can skip all these are prime broker here. Prime broker. Yeah, so what is prime broker here? Prime broker, uh, prime broker means it's a broker only, so they also act as the prime broker. But however, there is a difference here. Prime broker means it's like a personal assistant. Okay, so prime broker here, as in broker, but prime broker. That means they deal with hedge funds. So hedge fund means what? Now they are doing plenty of transactions. They do margin trading. That means they borrow, then they do short selling. So various transactions they are doing, right? So because they are doing various transactions, they need some personal assistant who will help them to settle all their transactions. Okay, so that's why that personal assistant that they require. So that time, so the name changes from broker to prime broker. So they are doing the job of a broker plus beyond that, because broker's job is just execute the instructions given by the investor. But here they are not only doing that, they are helping them in settlements, they are helping them in arranging for money if they are falling short of cash. If they are doing short selling, they are arranging for a proper settlement. So that's why they are working exclusively with hedge funds. If hedge fund need to borrow money also, this prime broker will help them to borrow money. Okay, so that is prime broker. Then insurance companies, all you would be knowing, right? Okay. Then here, moral hazard and adverse selection. So what is the difference? Moral hazard occurs because the insured may take more risk once he is protected against the losses. That means imagine your car is insured. Now that might motivate you to drive more recklessly. Then it is what? Moral hazard. Okay. So moral hazard is, basically, uh, once you are insured, you are taking more risk there. That is moral hazard. Adverse selection. Adverse selection means occurs when those most likely to experience losses are the predominant buyers of insurance. That means when insurance are given to those people who are more likely to uh, actually uh, 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 you know actually use it, and in the sense they are going to actually fall sick, and they are going to make the company to pay for it. So that means the company has not given insurance to the right people from business perspective. That is adverse selection. Okay, adverse selection means giving insurance to those people who are more likely to actually use it. Okay, arbitrage also, anyways, we will be doing this in derivatives. Okay, so you can ignore this also now, arbitrage. With all these replications you will get doubts, all this, so better we'll do it in derivatives only. Clearinghouse. Clearinghouse and custodians. Okay. Okay, any doubts, questions based on whatever we have done so far? Any doubts?
No, sir.
No? Okay.
So can you please explain prime brokers again?
Yeah. So, say for example, see, there is something called margin trading. Margin trading means what, you know? Margin trading means if, you know, if the share price is 100 rupees, you might be, let's say, spending only 40 rupees. Share price is 100, you will spend only 40. Then who will spend remaining 60? Remaining 60, you will borrow. Remaining 60, you will borrow. Okay. So why are you doing like this? Because you are highly interested in this stock. You have less money, but you want to take your position here. So you will borrow. Now the question is, when you are borrowing, you are an investor. You have identified that this stock is good. You don't want to get into the headache of, you know, from where to borrow, at what rate to borrow, all that thing. So what will you do? You will directly talk to the broker and you will say arrange for money. Now the broker will arrange for this 60 rupees. Now that means this broker is doing more than the normal broker. You understood this one?
Yes, sir.
So he is helping in margin. This is called margin trading. That means you are giving only some margin and still you are able to trade. So he is helping here. Then you are doing many transactions, buy, sell, buy, sell, buy, sell. At the end, you user do not have the track. Now, who is going to track all those things? This broker will track and make sure that all are settled on time. And then imagine you are doing short selling. What is short selling? All those I will be telling you. Okay. So that means in that short selling also, you know, you need the broker's support to settle the trades properly. So that means whatever transactions you are doing, broker is keeping an eye and making sure that your focus is only on identifying the companies, right companies. Rest all back end work he will do it. It's like there is a director now who needs one assistant. Why personal assistant he requires? Because he has so many meetings. He cannot keep doing all the back end work of, you know, booking flight tickets and all that things. No? So that's why he will focus only on the meetings. Rest all the personal assistant will take care of booking flight tickets and, you know, travel time and all that thing, and sending requests for meeting and all those things. Assistant will take care of it. He will just focus on the meetings, right?
Okay, sir.
Okay. Yeah. Now clearing house. Okay. Now custodians. Okay. Yeah. Just 1 minute. Now clearing house and custodians. So what is this clearing house and custodians? See, custodian means what now? Custodian means, see, before understanding custodian, let's understand the term bank. What is your expectation from your bank? Anybody's expectation from your bank is what? First of all, my money should be safe. Safeguarding cash. Second expectation is what? Interest. Pay me some interest. Then plus additional services. Similarly, now, yeah. So this is the job of your bank. Now, how do you know that they are safeguarding your cash? So, if you are depositing 10,000 rupees in your bank, how do you know that they are safeguarding? Just think like a layman at the ground level. So, how do you know? You will immediately uh, do online. You will immediately online. You will check, or you will go to the ATM and you will check, or you will call the customer care and you will check. And if they mention that, you know, 10,000 is credited against your name in your account, then you will know that, okay, my money is safe. That's what safeguarding means. Okay. plus on the balances they will give you interest as well. Okay, and then also, and then what are you doing? Imagine you deposited 10,000, then you went for a movie, you swiped debit card, you went for a movie, and then you used debit card to uh, you know have lunch in the restaurant, then you are doing some shopping, and again you are using debit card. Now at the end, you yourself will not know what is the balance left out in your bank account, but the bank knows. So again, what will you do? You will go to the, you will pull out one mini statement and you will see all the transactions, and the bank will tell you, look, morning you deposited 10,000. After that, you spent this much here, 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 and now the total balance is 4,000 rupees. So then you will believe that the bank is safeguarding your cash, right? So basically, safeguarding means what then? Safeguarding means record keeping the transactions done by the depositor. Record keeping the transactions. Okay, record keeping the transactions. Record keeping the transactions. Okay. This is what they are doing. Now, custodian, what do? There is a lot of similarity. Custodian, they also do the work of safeguarding. They are also doing the work of safeguarding. Okay. So what do they safeguard? How do they safeguard? So the difference is bank is doing the work of safeguarding cash. Custodian is doing the work of safeguarding securities. That means here safeguarding cash will come into the picture when we are depositing and withdrawing. Deposit and withdrawal. And here custodian is doing the work of safeguarding securities, and here it is buy and sell of. So here they are safeguarding securities. Securities means what? Buy and sell. Buy and sell. So when you buy and sell shares, that has to be safeguarded, right? That safeguarding is done by the custodian. How do they safeguard? How do they safeguard is by record keeping all the transactions, because you are buying Reliance, you are selling ICICI, you are buying few shares, you are selling few shares, so many transactions you keep doing. So this custodian will record keep all the transactions, will record keep all the transactions done by the investor, all the transactions done by the investor, all the transactions done by the investor. Okay, we'll record keep all the transactions done by the investor. So now yeah, that is custodian. Okay, plus now they have to do some, if the company is paying dividends, then they have to pay dividends. If it is bond, then they have to pay interest. Okay, or in short, or if the company is paying bonus, then even that has to be given. Okay, so all these are together called as corporate actions. Corporate action. So they will record all the corporate actions. Okay, so that's why, that is the reason bank is already doing this work. Then bank thought there is a lot of similarity between bank and custodian. So HDFC Bank, which is doing this work, they took additional license and they became what? They became HDFC Securities. Okay, they became HDFC Securities. Okay. Similarly, ICICI Bank became what? ICICI Securities. Axis Bank, that became what? Axis Securities. Okay. Yeah, so that's the reason you will find banks playing both these roles here, because the role is quite similar in terms of safeguarding. Okay, so when they are doing all this work, they are called as custodian. Actually, as I said, custodian is one of the function of investment banks. So all these are what? All these are Indian investment banks. So normally when we say investment banks, we tend to give all international examples like JP Morgan, Morgan Stanley, BNY Mellon, uh, uh, Barclays, this kind of Goldman Sachs, this kind of names we give. But then we miss out on the Indian investment banks. These are all not so very big, like obviously those international investment banks, but these are all Indian investment banks. Okay, you got the idea what is custodian?
Yes, sir.
Okay, yeah. Then uh, there is one video that I made, trade life cycle. If you want, you may watch that also. That will elaborate highly custodian's work and clearinghouse also, but you don't require it for CFA. For CFA, you don't require. But if you have curiosity to know, like about more ideas about clearinghouse, I'm shortly going to explain now clearinghouse also. But if you watch this one, you will get more ideas about this clearinghouse and custodians connections, all those things. Okay, but it is not required for CFA. Just in case you are curious, you can watch that video. Okay, now coming to clearinghouse. Now, what do they do? See, clearinghouses. Okay, so clearinghouses. Uh, see, shortly I'm explaining. Okay, there is a buyer, there is a seller. Now they are approaching their broker, and then the deal is punched into the system, which is stock exchange. You think of this stock exchange as the mall where you are going to shop. Now, once you shop, then what will happen after shopping? Then you will go to the cash counter, right, to settle the transactions. Okay, you have to go to the cash counter. That cash counter is over here. That cash counter is called as clearing house. Once you go to the cash counter, what will you say? That please clear my account. I have to go out quickly. Similarly, here also that clearing house is the cash counter. So all transactions will come over here. All the records, all the transactions done, in the stock exchange platform will come over here. Then they will coordinate. And they will inform to the custodian about the transactions. I'm just shortly explaining without going into the detail. Now this custodian also will come to know that you have placed the deal, because they are supposed to safeguard, right? So they will have to record all the transactions that you are doing. And the clearing house, so they will coordinate with the clearing house. Okay, and they will help in settlement. So clearing house is unofficially, if I say, it is like the cash counter of the stock exchange mall. Okay, stock exchange. So clearing house, they act as the central counterparty. What do you mean by this central counterparty? They act as the central counterparty. What do you mean by central counterparty? That means for the buyer, they are the seller. For the seller, they are the buyer. Mind you, buyer and seller, they don't even know each other. When buyer and seller, they don't know each other, buyer and seller, they don't even know each other. So, uh, buyer seller, they don't know each other, right? So how are they confidently entering into the trade? That is because clearinghouse takes the counterparty guarantee. Clearinghouse takes the counterparty guarantee. So clearinghouse takes the counterparty guarantee. Okay. Clearinghouse takes the counterparty guarantee. Okay, so clearinghouse helps in settlement. Okay, now so this part, I have elaborated in the trade life cycle video. You can watch that one, or even this much if you understand, it is fine only. Okay, so they are the one acting as the guarantor. Okay, then yeah, they are reducing the counterparty risk. Okay, then custodians also we have seen. Then uh, okay, any doubts still here? Any questions?
No, sir.
No, fine. Okay, okay. In case if you are tired, we can stop now. If not, I can continue then. In case if you want me to stop now here.
Yes, sir.
Okay, okay, fine. Then we will stop now here. Okay, so we can continue from here tomorrow. Tomorrow is Monday, so Monday also, even, yeah, by
Tomorrow's Tuesday.
tomorrow is Tuesday. Okay, okay. Um, 1 second, let me stop the recording now.